Welcome to another monthly edition of the Rogers Capital Market Commentary, where we attempt to be the antidote to water cooler wisdom. This is, our Happy New Year 2025 market outlook. 2024, wow, what a year! Plus 25 on the S&P 500, 57 record highs throughout the year. That's the fifth most since 1957. But more importantly, no corrections, no 10% pullbacks within the year. The Mag 7, the big tech names we've grown accustomed to hearing about, the Facebooks, the Amazons, the Apples, the Netflixes, Googles, Microsofts, drove half of those, of that 25%. But a pretty good year for the market overall, driven by AI and just investor optimism. But now we look forward to 2025. We remain cautiously optimistic, coining this phrase of mine, pragmatic optimism. Optimism, but let's be pragmatic. Let's be reasonable about this. I'll walk you through four keys to 2025. This video here. Number one, no recession. So as we look forward to 2025, we don't hear about much danger of recession. We're in bull market year number 3 now, which started back in November of 2022. We're up over 67% since that time. Previous videos, we have covered what bull markets typically look like, how long and how strong they are. But to the recession point, history suggests a pretty good chance of celebrating a third year of bull market here, as long as the U.S. economy continues to grow. Reason number 2, supportive Fed. You've heard me talk before. Don't fight the Fed. Don't fight it when they're raising rates. Don't fight it when they're cutting rates. Base case remains 2 Fed interest rate cuts this year as inflation closes in on the Fed's 2% target, which should be good for stocks. S&P has produced modest gains of about 5.5 during the 12 months following an initial Fed cycle of cuts, with gains typically double that when we don't have a recession. Number 3, strong earnings. Now, valuations are high. In fact, this new administration is inheriting the most expensive stock market that any president has ever inherited. And when I talk about most expensive, we're not talking about just the values being the indexes being the highest points. But the index is what we're paying in relation to earnings or profits. Valuations are high. Earnings growth is going to be required to lift this market going forward. But 2025 earnings should follow that. Corporate profits carry the potential this year to grow at a double-digit pace, backed by steady but slower economic growth, limited wage inflation, AI investment and productivity gains, and deregulation. All of that should drive earnings, tax cuts, should drive earnings higher. And so that's number 3. Number 4, fiscal, trade, regulatory policy. With the new administration coming in, we have heard about tax cuts, cutting a lot of the regulatory nonsense out so that businesses can be more productive. We also kind of have a little bit of a unique position here in that, most of the time when a new administration's coming in, we don't know necessarily what they're going to do. We've heard them talk, but we're not sure what they're actually going to do and be able to do. And we're unique in the fact that this administration's been in here once already, 4 years ago. was in here. Cut taxes, cut the regulatory environment. So we can look back and see what the effect was. Those policies, fiscal, trade, regulatory policies, offer quite a bit more upside than downside. Trump 2.0 is expected to reduce the regulatory environment, cut taxes, tariff, at least from a negotiation standpoint, use those tariffs to achieve the administration policy objectives. So that's number 4. But those 4 strong points and keys for 2025 aside, let's just talk history. The average year for the S&P 500 since 1950, what would you guess? You maybe heard this around, that the market does 10% every year. Well, the actual number's 9.5. Since 1950, the S&P's done 9.5 per year. And the market's up about 3/4 of the time, 72%, but about 3/4 of the time. But what about after a good year, 20% year? Well, that average actually goes from 9.5 to 10.5. And we saw that last year, another strong year. But what happens after you've had 2 strong years, 2 20s back to back? Well, that average for the following year goes from 10.6 to 12 on average. And it's been higher. We've had 8 of those years. It's been higher 3/4 of the time. The only 2 that weren't higher were 1977 and the year 2000, which was interesting. It's not easy to put 20s on the board year after year after year. We've had 2 already, but history suggests that we can keep that going. In fact, interesting correlation between the tech boom, the dot-com boom in the late 90s, Bill Clinton era. We had strong years, 95, 96, 97, 98, and 99, 5 in a row, 20 plus years. And interestingly, kind of driven by technology and this time maybe the driver being AI. But an interesting correlation there, of course, until 2000 when the dot-com bubble burst. But if history's any guide, if our 4 keys to a strong 2025 of no recession, a supportive Fed, strong earnings, fiscal, trade, and regulatory policies, if those come through, I think we can be pragmatically optimistic about 2025. That's it for this month. We'll talk to you next time.